Over the last few days, the market capitalization of one of India's most prominent companies evaporated by 28,000 crore rupees. Among the heaviest losers in this collapse is the Life Insurance Corporation of India. LIC holds a massive stake in the firm, over 10% of the company's shares. Alongside LIC, nearly 200,000 everyday retail investors are trapped in the stock, watching as the share price hits lower circuit limits day after day, making it nearly impossible to sell. Rajesh Exports, a firm that pitched itself to the public as one of India's most successful gold refiners and jewelry manufacturers, now sits at the center of this market failure. The catalyst for this sudden collapse is a multi-year investigation by India's market regulator, SEBI. Following a shareholder complaint, SEBI took a hard look at the company's books and found signs that its success may have been fabricated. Investigators uncovered an accounting discrepancy totaling 15.15 lakh crore rupees, a figure projected over a 5-year period. Thousands of shareholders are now left watching as the company's massive paper promises collide with a sudden, devastating lack of verifiable evidence. To understand how a company projects this level of growth, we have to look at the difference between standalone revenue, the money generated by the main company itself, and consolidated revenue, which lumps in the income of all its subsidiaries. On paper, Rajesh Exports reported an astronomical 15.44 lakh crore rupees in consolidated revenue between the financial years 2020 and 2025. But SEBI found that up to 99% of this massive total originated from overseas subsidiaries. The company claimed the vast majority of its business was happening through a Swiss gold processing subsidiary called Valcambi SA. This chart compares the reported revenues. On the left, the towering 15.44 lakh crore consolidated figure. On the right, the standalone revenue for the Indian holding company, a tiny 26,000 crore rupees. Verifiable Indian operations accounted for less than 1% of total revenue. By exploiting this massive overseas gap, the company projected the image of a global juggernaut, all while operating as a fraction of that size domestically. The company also tried to justify its massive valuation through physical assets, specifically claiming an investment of over 1,000 crore rupees in African gold mines. During their investigation, SEBI asked for details regarding this massive non-current investment. They found absolutely zero financial records, valuation reports, or any documentation proving that these African mines actually existed. This complete lack of physical proof points directly to a failure by the gatekeepers. The company's auditors neglected their primary mandate by failing to verify these phantom physical assets or red flag the missing documentation. Those same auditors also rubber-stamped highly questionable related party transactions. SEBI found instances where company funds were routed directly to the personal derivatives trading accounts of the promoters. When SEBI demanded the financial data for the foreign subsidiaries doing 99% of the business, Rajesh Exports invoked the Swiss Federal Act on Data Protection, effectively turning their overseas operations into a corporate black box. A multi-billion-dollar illusion remained unchallenged for years precisely because of this combination of fabricated overseas assets and total auditor negligence. It is important to clarify a vital nuance about this situation. This is not a case of 15 lakh crore rupees being physically stolen or embezzled from India's treasury. The 15 lakh crore figure represents fake accounting padding. It is a fabricated turnover designed specifically to artificially inflate the company's valuation and attract unsuspecting investors. The illusion signally shattered when SEBI issued an interim order that barred the promoters from dealing in the securities market. The stock violently plummeted because the market was suddenly forced to reconcile the company's bloated share price with its actual, much smaller financial reality. The lasting significance here is the vulnerability of the victims. Even institutional giants with massive resources, like LIC, can be devastated when corporate governance completely fails and auditors look the other way. For retail investors, the takeaway is clear. High consolidated revenues are a meaningless trap if the physical assets and standalone domestic numbers are hiding in the shadows.